Well, Patrick is a distinguished tax lawyer.
I have over 14 years of experience in tax advisory.
And what are the deadlines? How can individuals and businesses be better prepared?
When it comes to deadlines, and let's focus on corporate tax, deadline is that within 9 months from the end of your tax period, which is your financial year, you will have to submit your tax return.
Small business owners, and we want to discuss penalties associated with VAT or corporate tax. What are the common pitfalls? How
Sure.
can businesses avoid them?
Sure.
Ladies and gentlemen, good morning, good evening, or good afternoon. I know my audience is now getting more into the world. So here we are. Thank you very much, your amazing souls. Welcome back to accelerating episode of Monday Talks. We are here to bring not just interviews, but great minds that have greater stories. I'm Danial Tokath, your host. Today we have an amazing guest. His name is Patryk Karczewski. Nice to have you, Patryk.
Thank you for having me.
Well, Patryk is a distinguished tax lawyer and partner in AMERELLER Tax. Join us as we delve into professional journey and explore key intriguing topics about the realm of taxes and laws in UAE. So before we start, here's a message from the heart. Is like every subscription, every like, every share means the world to us. It's not just about numbers, it's all about incredible community we're building together. So if you haven't already, make sure that you hit subscribe button, drop a like, and share you with your friends. It means a lot because it's more than just a support. It's a journey. We're taking it together to spread great minds and greater even their stories to leave an impact to the world, to this generation and the next one. So let's go do it. All righty. Let's say I always ask that. Who is Patryk in your tongue?
Well, that's quite an interesting question. So first and foremost, I'm a husband and a father. I would say that's more important. That comes before my professional journey. That's definitely number one. But when it comes to my professional way and professional life, I come originally from Poland, as you can see from my surname probably. And I have over 14 years of experience in tax advisory. I started in Big Four in Poland, then I moved to the UK, and since 2017, I have great luck to be here in the UAE and advise businesses from various industries and from various countries across GCC.
Beautiful. So it's beautiful that you started Patryk the person first.
Yeah.
Beautiful. So I know tax issue is like now it's the talk in the market. So can we talk more about just general introduction, overview of taxes, VAT, corporate tax, and what are the deadlines? How can individuals and businesses be better prepared?
Sure. So when it comes to UAE, it's originally and in the mindset of lots of people that it's like tax-free environment and tax-free country. But actually, if you look at it historically, it is since many decades that there is emirate level taxation in the UAE, right? But obviously it was tackling just a handful of industries like oil and gas or branches of foreign banks. They had to pay emirate level tax. But the matters accelerated in 2017, where in October 17, the UAE decided to introduce excise tax. And excise tax typically is called as a luxury tax or sin tax because it's typically imposed on items or materials that are not healthy for you or not good in general. So those taxes, the excise tax was imposed on tobacco, energy drinks, and carbonated drinks, right? And then it was expanded to all those vapes, etc., and even sweetened drinks. So that was 2017. Then 2018, 1st January, we have value-added tax, 5%. And this was something that created more, I would say, interest from the market, because it is very widespread, very wide tax-based tax, right? Everyone goes to the store and you pay 5%, right? So that was effectively touching everyone, right? Taxpayer was the business, but we as customers, we were the ones actually paying the tax. And then 5 years fast forward, from June 2023, we have corporate tax, right? And that's another layer that the government put on the businesses. We have 9% standard rate. If you are trading above 375,000, if your taxable income is above 375,000 dirham, below that, zero. And also we have special regime that I believe we will talk about. When you are registered in a free zone, there is a possibility that you can lower the tax to basically 0%, but it's not that easy. And I will tell you why in a moment. But when it comes to corporate tax and this 9%, it's not necessarily about payment of tax, because lots of businesses, those small and medium enterprises, most likely they will not pay tax because they will not be able to make income of $100,000 or more. But it's about compliance and that sort of obligations that are imposed on those entities. We have many clients that are surprised that I just have an office here and I'm registered here. I have a branch. So what should I do? It's not covering me because we are not doing anything here. But unfortunately, it's not the case, because they will still have to go through the registration process and they will still have to submit tax returns, even though they will be nil tax returns, but they will have to do that. When it comes to deadlines, and let's focus on corporate tax, deadline is that within 9 months from the end of your tax period, which is your financial year, you will have to submit your tax return. You don't have to wait the entire 9 months. You can do it quicker, but the UAE, the Federal Tax Authority, gave you 9 months to prepare everything. Obviously, the basis for tax return will be your financial statement, not necessarily audited financial statement, because audited financial statements are required only for certain types of businesses, but you have to prepare some books of accounts, financial statements, and based on that, determine whether you have to pay tax or not. And that has to be submitted to the FTA, tax return, because financial statements are not submitted to the tax authority unless they ask for it. And obviously they can ask for additional materials, additional documentation that is needed. So those of you who are listening that are thinking, okay, so it's 9 months, my tax year, my financial year is 2024. So easy calculation, by September 2025, I have to provide something. So all good and well, I don't have to do much right now. But that's not necessarily true, because your opening balance, which basically how you're going to start your 2024, has to be calculated in line with the legislation, even though you are not covered yet by the legislation, especially when we are talking about so-called related party, right? If you have business that is owned by the common owner and there was some transactions going on between them, most likely, as majority of businesses here, because it wasn't required, they will do it at cost and not necessarily at market value, right? Mm-hmm. So any sort of balances that will be moved forward, they have to be recalculated with the idea that how it would look like if we trade at market value. So there is some work to be done. And any decision that you are discussing right now related to tax, it has to be documented as well, because that is considered a tax record for Federal Tax Authority, and they can ask for it. So even if you meet with advisor, even if you discuss internally, for example, do we want to do tax group? Do we want to go to free zone? Whatever the reason is, that should be documented, because Federal Tax Authority can request that to ask you, why did you move your business to this area? Or why did you change your license in that to remove certain activities, for example? Because they want to see if you did it for commercial reasons or if there is just pure tax gaining, tax advantage gaining, right? So that's a little bit about deadlines and introduction.
Okay, so you mentioned something about taxable revenue.
Yeah, taxable income.
Taxable income.
Yeah.
Can we explore more about that?
Sure. So taxable income, this is the basis for your corporate tax. And the starting point to identify how much is your taxable income will be your financial statement. So your accounting net profit, that is your starting point, right? Then you can do certain deductions, you can apply certain credits, reliefs, etc. And as a result, you will arrive to taxable income. If this taxable income is more than 375,000, you pay tax on whatever is above 375,000.
Can you give us examples of those deductions?
Sure. So for example, different than VAT, you have your accounting net profit of, let's say, 1 million, right? And one of the deductions that you can apply is your depreciation of your capital asset, right? You cannot deduct the cost of the asset if you're buying. For example, you buy, huge machine that costs lots of money because that's your capital expenditure. So you cannot deduct it from your profit. But what you can is you can depreciate it over time, and this depreciation you can deduct from your profit over time, right? Similarly, if you organize an event or any actually expense that is business related, you can deduct it from your taxable income. For example, even if you do some entertainment for your clients,
can be deducted.
You can up to 50% though.
Okay.
Yes, so 50% of the cost can be deducted. It's different than VAT because for VAT, you cannot recover the tax that you incurred on that. So technically you cannot deduct for VAT, but for corporate tax, up to 50% you can. Also, if you have situation where you have activity outside of the country and you pay tax in that other country, then you can deduct this tax using something called foreign tax credit. So there are a little bit more technical issues, but effectively the general rule is if you have any expense that you incurred wholly for business purpose, then it should be deducted.
Okay. You said depreciation on equipment or assets, right? So this includes, this should be big, huge machines, or it can go down to the laptops?
No, it can be anything. Basically, whatever you put in your books as the asset, it doesn't have any capital expenditure of certain value. Whatever you put in your books and whatever you depreciate according to your accounting rules, then you can deduct it over time. Yeah.
Okay, let's go for free zones in the UAE because it's foggy there. It's like doing business in and out, and we want to look at it from tax perspective.
Sure. So when it comes to free zones, a little bit of a introduction why we have separate regime for free zones. Before the corporate tax was introduced, lots of those free zones in their establishment laws or in their regulations, they were saying that come to us, you'll virtually pay no tax. We will give you tax exemption for up to 50 years, right? And that was something that the lawmakers, when they were drafting corporate tax, they had a little bit of an issue with because it just complicates the system, right? So initially, the first idea was, let's put everyone on 9%. Yes, let's put threshold on the taxable income, but let's not introduce separate regime for free zones. But unfortunately, that could create a risk of litigation, right? Because those companies, they signed the agreement, they had a promise of 50 years, up to 50 years tax-free environment. So right now, if someone tells them, well, you have to pay 9%, obviously that, that can create some issue. So then a qualifying free zone person regime was introduced because it's not necessarily enough, or actually it is not enough if you are just a free zone person, right? If you are within the free zone, that doesn't mean automatically that, okay, you pay 0% or you don't pay tax. You have to meet further conditions and further requirements that are quite tough to meet, to be honest, to qualify for this free zone, right? One of the requirements, the main one, is that you have to derive the qualifying income. And what is the qualifying income? The qualifying income is not defined in the law per se, but is defined by the combination of with whom you are trading and what are you doing, right? Because if you are trading, if you're a free zone person and you are trading with another free zone person, then you just need to take care that your activity is not on the list in ministerial decision that is named as excluded activity. So you can do everything but excluded activities. If you are trading with someone who is not a free zone, so for example, for an entity or mainland companies, then you need to look at, okay, is my activity on excluded activity list? No, all good and well. But then is my activity on the list of qualifying activities? So there are two conditions there. So if it's not, then it doesn't qualify as qualifying income. You have to pay regular tax on it. So there is like a huge list that was already changed. And
but okay,
just
again, we have to check it over the threshold, which is like exceeding 375 or not.
No, so you see, that's another interesting U-turn here, because for free zone persons, if you want to go for qualifying free zone person regime, there is no threshold. So even if you make 10 dirham from non-qualifying activity, from non-qualifying income, that's going to be subject to tax of 9%, right? It's
So
not
let's
something
have a look of qualified and non-qualified.
Sure. So to give you an example how complicated it is, the first list was published in May 2023, and it has already been changed. So in May 2023, the first list was released, and it created a little bit of commotion in the market and amongst businesses. So the public consultation was initiated by the Ministry of Finance when they wanted to listen to the business, what is their expectation. And then the expectation was laid down, so they changed the decision. And it was basically beginning of November where they changed both decisions. So when it comes to qualifying activity and excluded activity, I can quickly run you through it, but it's quite a lot of and quite technical information. So for example, when it comes to qualifying activities, you have manufacturing of goods and materials, right? You have processing of goods and materials, you have investment activity, you have insurance activity, distribution, etc., etc. But interestingly, services are not included, right? So if you are a free zone business providing, I don't know, consultancy services, then if you are trading with someone who is not a free zone, that will be your non-qualifying income. But if you are trading with someone who is within free zone, then all good and well, because consultancy activity is not on the list of excluded activity. It is quite complex, and it requires a little bit of in-depth analysis of every single transaction that you have. But interestingly, just to give a little bit of insight, if you trade with natural person, so someone like me and you are in the free zone, that's automatically excluded activity unless we are talking about couple of activities like investment activities, wealth management, leasing of ships or yachts or leasing of planes, right? So those activities are specifically carved out to cater for high net worth individuals, right? So if you're a free zone company and your core activity is trading with, I don't know, renting yachts or selling yachts to, rich people, that will not be excluded activity because it's carved out, right? But if you are dealing with anything else, providing services, etc., that will be carved out. So this is the main problem when you assess whether you can apply for qualifying free zone person or not, right? Whether you are actually doing this qualifying income. It is possible when you are doing qualifying income and non-qualifying income that you still will qualify. But again, there is.
Oh my God!
I'm sorry. There's lots of ifs.
I'm lost.
Yes, I'm sorry that there's lots of ifs and buts there, but it's not very straightforward. For people who are listening to us and who are not necessarily
Just like
professional.
let's try to make it simple.
Sure.
Okay.
Sure.
Let's not go into very deep detail. Okay.
Sure. So
I'm a free zone, and I offer. Let's have this example. I'm a free zone, and I have services, and I sell mainland entities.
Sure. Okay. You will not be qualifying free zone person.
Okay,
Yeah,
that's
that's
good.
easy. Out of the window.
So I will be in this threshold thing.
Yes, yes.
Right?
You will go as a regular taxpayer. Yes, yes.
Okay. So just like I will be treated as a mainland. Same
Correct.
treatment.
Yeah, the same principles. Yes, the same principles.
Okay.
Yeah.
Cool. Does
Um,
it matter if I do business with the mainland or with the free zone? I mean, out of the country.
It depends, right? When you are doing in the mainland and outside of the free zone, actually no, because they are both treated as non-free zone persons. So whether you're doing with international or foreign entities and the UAE mainland, there is no difference there.
No difference. Okay.
If you're dealing with free zones, then you may have possibility to apply the 0%. However, what I typically advise to businesses that are located in the free zone, and I'm talking about businesses that are registered in the free zone and all that, when they have relatively small level of operations, let's say below 3 million dirham, there is another possibility to basically eliminate tax from your headache. This is something called small business relief, right? If you are 3 million, if your revenue is below 3 million, and doesn't matter whether you're free zone or non-free zone, you have to just be a resident, meaning registered in the UAE. You are ticking the box in the tax return when you are saying, I'm applying small business relief. And then there is a fiction that you don't have any taxable income. So basically that eliminates you from any tax headaches, right? Even if you had income, let's say your income is 2 million, right? You are very profitable business. Your cost base is very low. Your revenue is 3 million. Out of that, you made 2 million profit. And then you will not pay any tax on it because you're a small business, right? However, there is a trick here because this will work only up until end of 2026. This is just to soften the blow for businesses that are relatively small, that let's say cannot afford tax consultancy, accounting, etc., all this full-fledged. So to give them another 3 years to basically prepare. Just to remember, trigger the small business relief, all good. You are out of, there is no problem about you. But be ready that once 2027 comes, it will no longer apply and you will have to actually, be ready with your accounting, with your treatment, etc. Right? So yes.
Okay. When we talked before, you were mentioning, or you talked about solution like a software for tax compliance or something like that.
So you can hear from my conversation about qualifying free zone persons, right? That it is quite complex, right? And another thing that you need to, if you want to go for qualifying free zone person regime of the 0%, then one thing that we didn't speak about that you have to pay attention to is something called de minimis threshold, right? Which means if your certain type of revenue is more than 5% of your total revenue or more than 5 million dirham, whichever number is lower, then your entire income becomes 9%, right? Subject to 9%. So for certain businesses who want to go for qualifying free zone person, it is extremely important that they are able to separate their revenues and their expenditure into, let's say, 3 buckets, right? First bucket will be, okay, qualifying income, no problem. Second bucket will be, well, non-qualifying income, but still not counting to my de minimis level. And third, the one that counts against de minimis level. And to be frank, there is no software, like if you work with SAP, if you work with Oracle, there's no software that can cater for that at the moment. So what we are devising with our tech partners, right, is the software that can help you track that. So you basically allows you close to real-time tracking on how much is in every single bucket that I have. Because once you reach to 5%, once you are close to this 5% in this de minimis bucket or to 5 million, then you may have to do some business decisions whether you actually, want to, I don't know, move this transaction to the next year, or you want to put pause on it, etc. Because if you don't, then it will cost you 9% of your profit, right? It will require preparation to corporate tax, will also require you to look at your ERP, even if you have great SAP, great Oracle, or whichever big player in the market, or even smaller one. You have to look at your chart of accounts that you currently have and look at it from the perspective of tax legislation. Do you have all the buckets separated that you would like to have when you prepare tax return, right? Because opposite to VAT is like rolling situation. You pay every month or pay every quarter, every transaction counts. Here, you just do it once a year. So I advise, whoever listens to us and whoever is subject to corporate tax, not to wait for the very last moment and think that, okay, let's 2024 run as it is, and let's see how it goes on our tax return. Because then you're making your accounting life very hard, because once he will have to prepare the return, he will if you don't have proper buckets, if you don't have proper, enhanced chart of accounts, he will have to go transaction per transaction for the last 12 months and figure out, can I deduct this? Can I not deduct this? Etc. Unless you're happy to not use any deductions and just pay, flat 9% from your profit, which I believe, you may lose certain amount of money. So this is important.
9% from the profit or 9% from the revenue?
Yeah, but if from the profit, right? But if assuming that you didn't do anything in your ERP and you are not interested in it, so your accounting statement will say the profit is XYZ, right? And if you are not able to demonstrate on what basis you did your deductions, then you won't be able to do any deductions, right? So whatever your financial statement will show, boom, flat out, you will pay 9%, right? Some businesses are saying to us that, okay, it's fine, because they have some international, they are bound by Pillar 2, for example, where the minimum tax is 15%. So for them, whether they pay 9 here, they will still have to pay in their country of origin additional, 6%.
This is another question. If it is double taxed.
Yeah.
Right?
Well, I mean, it's more like top-up tax in their country, but some businesses are not interested in decreasing their taxation or optimizing their taxation here, because they are saying, okay, but in my country of origin, where my capital group is consolidating, they will still have to pay for it. So we don't want to invest in it, right? And I understand that, because there is no interest, material, financial interest for them to invest in it, and that's all good and well. So it is important to conclude. It is important to have a proper enhanced software, and also if you want to be qualifying free zone person, it is good to to look for some sort of customized and tailored solutions, and that will help you track all those categories to remain compliant with qualifying free zone person regime.
Okay, let's get back to it. Less complication.
Sure.
We are business owners, let's say small business owners, and we want to discuss penalties associated with VAT or corporate tax. What are the common pitfalls? How can businesses avoid them?
Sure. So one of the, just a couple of words of the introduction, the VAT and excise has different penalty regime than corporate tax. Because they are slightly different taxes. VAT and excise is indirect tax, corporate is direct tax, so there are slightly different financial repercussions for it. As a result, if I can say, the corporate tax penalties are lower than VAT and excise penalties. Of course, we have some common situations that, okay, I missed deadline, right? I missed deadline to submit my tax return. And for VAT, it's 1,000 dirham, right? And it's a flat penalty. For corporate tax, it's 500 dirham for every month that you are late, right? So it's slightly different construction, but still relatively small fine, right? But the big difference is when it comes to voluntary disclosure. And voluntary disclosure, this is an institution where the Federal Tax Authority or the lawmaker allows the taxpayer to report mistake without being prompted, right? So let's say I did some return, and afterwards I realized that, okay, this shouldn't be deductible, or, I paid not enough tax, right? So I want to go to Federal Tax Authority and say, okay, I made mistake. This is the reason for the mistake. I want to pay extra money, whatever I missed to pay. And for corporate tax, the penalty for that is 1% per month, right? From the moment you are due to pay until you actually paid. For VAT and excise, it's anything between 5 and 40%.
Wow.
Right? So it depends in which year you realize that you made mistake, right? Because there is like 5 years within which the tax authority can come to you and audit you, right? So let's say if you are in the last year, if you are between 4th and 5th year in VAT, then your penalty is 40%, right, of whatever you missed. Plus you have some, interest per month that you are late. So also another thing that's associated with the voluntary disclosure, if the tax authority came to you and you decided, okay, yeah, they started, looking around my records and I know I did something wrong, but I didn't want to pay penalty, so I never told them that I did something wrong, right? So for corporate tax, if you did it, it's 15% penalty of whatever you missed. But for VAT, it's 50%.
Wow.
So
wow.
Since VAT is more transactional and VAT is relatively easier, if you can say that about tax, but it's relatively easier to discover that you did something wrong, right?
Yeah.
Since corporate tax is based on financial statements and accounting treatments sometimes, so not necessarily when you sit, things can be black and white. That's why the penalties are relatively smaller, because the Federal Tax Authority understands, okay, there may be some, difference in interpretation, etc. There is no ill will or something like that. Like that's the reason why they're smaller, why they're lower.
Okay. Oh, we're running out of time. But one last question I would love to highlight here. In your experience, what distinguishes a tax lawyer from accountant in handling complex tax matters?
Sure. So, I think both are needed, right? Because they're needed for different reasons. Accountants, in my understanding and in my experience, they are way better with numbers than lawyers, obviously. And they are the ones who are responsible for preparing your books. And this is something that gives us basis to work. However, my perspective, and I'm a lawyer by education, tax law is still a law, right? So whenever you enter into some sort of gray area or, new transaction that is not typical for your business or new business model, it's always good to consult someone who knows how to read the law, knows how to interpret and fill the gaps that are not black and white, right? Because the law is not written, and it will never be written to cover all the transactions, all the options in the world, right? Because then it would have to be, thousands of pages.
Yeah.
So you need someone who knows how to interpret, what are the rules of interpretation, and how to make sense from the law, how it can apply to your situation. Not to mention, if you start having some sort of disputes or audits with Federal Tax Authority or any authority anywhere in the world, it is always advisable to have someone who knows the law, who knows the boundaries within which the tax authority can move, right? Because we have tax procedural law here, and we have certain rules how to appeal, how to conduct a dispute with tax authorities. And accountants, from the experience, sometimes they are great with what they are doing, but they are not technically trained to do that. Just like I'm not trained to classify entries according to accounting rules, the same way they are not trained to interpret the law and to carry the dispute with the authorities.
Beautiful. Have to wrap it up here because we're already consumed all the time. So thank you very much, Patryk.
Thank you, Daniel.
That's a wrap up for today's insightful episode of Money Talks with our esteemed guest, Mr. Patryk Karczewski. We extend our gratitude for sharing your wealth and knowledge and interact with the world of tax law. To our audience, thank you very much for tuning in. Remember, knowledge isn't power, and every Monday we strive to bring you conversation that enlighten and inspire. Stay tuned for more enriching discussions on Monday Talks. Until next time, I'm your host, Danial Tokath, signing off. Stay informed, stay empowered. Bye for now. Thank you, Patryk.
Thank you so much, Naeem.